Welcome back, Focus Learners! I'm your host, and today we're bringing you a special high-energy edition of our explainer. Today, I'm putting on my coaching hat because we are doing a rapid-fire masterclass to help you completely ace the Intuit Personal Finance Certification. We are stripping away all the fluff, okay? We're focusing purely on the core definitions, the essential concepts, and the financial structures you absolutely need to know to succeed. So grab your notes, and let's get to work.
Now, you'll probably recognize this logo. The exam is officially administered through Certiport, and the syllabus is, well, incredibly structured. But don't worry, our explainer today is mapped directly to those official objectives. Rest assured, we are going to cover exactly what you need to know so you can confidently sit down at that computer and just pass with flying colors. Here is our game plan for today. We'll start with income and tax basics, then move into budgeting methods and spending. After that, we'll hit banking and saving essentials, dive into investing core concepts, and wrap it all up with managing credit and loans. All right, Section 1, Income and Tax Basics. Let's jump in.
The absolute crucial starting point for the exam is understanding this first major distinction: gross income versus net income. Think of gross income as the big, impressive number you might brag about. It's the total amount you earn before anything is taken out. But net income? That's your actual take-home pay. It's the slightly sadder number that actually hits your bank account after all the deductions. You know, things like federal, state, and local taxes, Social Security, Medicare, and voluntary withholdings like a 401k. The exam will absolutely test your ability to tell these two apart, so lock that in. And speaking of taxes, let's decode the alphabet soup of forms guaranteed to show up on your test. It's like a giant puzzle, but pretty simple once you see the pieces. When you start a job, you hand your employer a W-4 to set up your tax withholdings. Fast forward to year-end, and they hand you a W-2 summarizing those taxes. Now, if you're a freelancer, or what the exam specifically calls an entrepreneurial venture, you get a 1099 instead of a W-2 for your non-employee income. Finally, the 1040. That's the master form you actually file with the government to do your taxes. Memorize these four? For sure. Moving right along to Section 2, Budgeting Methods and Spending.
Before we get into the exact formulas the exam wants you to know, ask yourself which method actually aligns with your personal goals, because budgeting definitely isn't one size fits all. The syllabus emphasizes that your specific goals, whether that's paying for college or saving up for a house, really dictate your strategy. The exam specifically requires you to know 3 distinct budgeting methods. Let's look at the first one. First up is zero-based budgeting. The definition here is super strict. Your income minus your expenses must equal exactly 0. Before the month even begins, you give every single dollar a specific job description. Whether it goes to rent, groceries, or beefing up an emergency fund, literally nothing floats around unassigned. If you have $50 left over at the end of your planning, you have to assign it a job until you hit 0. Next is the incredibly popular 50-30-20 budgeting method. Here's the breakdown. 50% of your net income goes to needs. These are your non-discretionary expenses like housing, basic utilities, and groceries. Then 30% goes to wants. These are your discretionary purchases, things like dining out, buying concert tickets. And spoiler alert, your premium streaming subscriptions definitely do not count as a need. The final 20% is strictly dedicated to savings and debt repayment. The exam loves testing your ability to differentiate between those discretionary wants and non-discretionary needs. The third required method is envelope budgeting. This is really more of a behavioral strategy. You allocate cash into physical or nowadays digital envelopes for specific spending categories, particularly for variable expenses like entertainment or eating out. And here's the catch. Once the entertainment envelope is empty, the fund stops for the month, period. It creates a hard boundary that strictly limits you and prevents you from mindlessly swiping a debit card. All right, Section 3, Banking and Saving Essentials. The certification requires you to compare financial institutions. While they offer very similar services, they have fundamentally different ownership structures. Traditional banks are usually for-profit, while credit unions are member-owned. But here is the golden exam detail you need to remember. Traditional bank deposits are insured by the FDIC. Credit union deposits, those are insured by the NCUA. Commit those 2 acronyms to memory right now and associate them with their respective institutions. It's a guaranteed point. Now, banking isn't always free, and test takers frequently overlook the costs and risks associated with consumer banking. You need to be hyper-aware of non-sufficient funds fees, ATM fees, and sneaky monthly maintenance fees. But honestly, more importantly, pay attention to the impact of inflation. Think about it. If your money is just sitting in a traditional savings account earning less interest than the rate of inflation, your saved funds are actually losing purchasing power over time. That is a massive concept to grasp for this exam.
Next up, Section 4. Investing Core Concepts. This is where we build wealth.
In investing, risk and return are heavily correlated. Basically, the more risk you take, the higher the potential return, but also the higher the potential for catastrophic loss. Government bonds sit comfortably at the low-risk level, generally providing steady income through interest. Step it up a notch, and we have mutual funds and exchange-traded funds, or ETFs. These offer medium risk by diversifying your money across many assets, yielding both dividends and capital gains. At the high-risk end, individual stocks and digital currency. We're talking high volatility and heavy reliance on capital gains. Knowing how your personal risk tolerance aligns with these specific classes is mandatory for the test.
Okay, pay attention to this number because you will definitely see it. The rule of 72. It's actually a mental math trick that dates all the way back to Renaissance mathematicians. By dividing the number 72 by your expected annual interest rate, you can estimate exactly how many years it will take for your investment to double. So, say you've got an 8% return. Well, 72 divided by 8 is 9, which means in roughly 9 years, your money doubles. It's simple, but highly, highly testable.
Finally, Section 5, Managing Credit and Loans.
Categorizing the mechanics of lending really comes down to one word: collateral. Secured loans require a tangible asset as collateral. Think of an auto loan or a mortgage. If you don't pay up, the lender comes and takes the car or the house. Unsecured loans, on the other hand, like credit cards and personal loans, do not require collateral. And because they are significantly riskier for the lender to issue, they typically saddle you with much higher interest rates.
Your credit score factors are heavily tested. Payment history is absolute king here. But you must also know the term capacity, which is your ability to actually repay loans based on your current debt load. Lenders also look at the specific types of debt you hold. And remember, your credit score isn't just about getting a loan anymore. It has huge real-world impacts. It dictates whether landlords approve your rental application, if employers will hire you for certain jobs, and even the rates you pay for car insurance.
For managing debt, you've got to know the difference between these strategies. The snowball method pays off your smallest debt balances first, giving you a quick psychological win. The avalanche method targets the debts with the highest interest rates first, for a purely mathematical win. And if those management plans fail, well, there is bankruptcy. The exam fully expects you to know that this is the absolute last resort, bringing severe, long-lasting damage to your credit score and your financial future.
And there we have it. We have rapidly moved through the core Intuit personal finance certification objectives. From decoding W-2s to utilizing the magic of the Rule of 72, you now have the structured foundation required to sit down at that Certiport terminal and absolutely crush this exam.
But before we go, I want to leave you with one final thought. Passing the test is fantastic, and with this explainer, you are well on your way. But the real test begins when you log off. You now know the definitions of zero-based budgeting, the awesome power of compound interest, and exactly how credit capacity works. So the real question is, how will you use this newly acquired knowledge to build your own financial freedom out there in the real world? Thank you so much for learning with me today, and best of luck on your certification. You've got this.